I want to talk about where we are in the business cycle, how the economy is shaping up, what it might look like in 2025. My presentation today is entitled The Good, the Bad, and the Ugly. This is a Clint Eastwood themed presentation. You'll see that theming throughout the presentation, whether you like it or not. I hope you don't hate it. It's firmly baked in the cake. And today I will share with you some good, some bad, and some ugly. But as it turns out, I will start out with the good. And there has been a lot of good macroeconomically. In particular, the U.S. economy has so vastly outperformed anyone's expectations. There was a conventional wisdom coming into 2023 that recession was inevitable in America. Indeed, the economists at Bloomberg, that source of phenomenal business intelligence, maintain a forecasting model, and that model was suggesting, as of October of 2022, that the probability of recession in America was 100%. And you may be aware that that is the highest possible probability, that in fact you cannot get beyond 100% unless, of course, you talk about the Baltimore Ravens defense, which, as you've heard, gives 110%. But otherwise, 100% is the most that you can get. 2022 was a terrible year for the U.S. equity markets. It was also the year that interest rates took off, and these are thought to be precursors to a broad-based economic downturn in 2023 and perhaps beyond. It did not happen. The broadest indication of U.S. economic progress is growth in output as measured by gross domestic product. Quarterly data, annualized rates of growth. Much of the data I will show you today are time series data, so the more contemporary data are to the right of the slide. Now, we're almost through the third quarter, obviously. Effectively the last week of the third quarter, but we only have data through the second quarter. And during the second quarter of 2024, the U.S. economy expands 3% on an annualized basis, above trend as it turns out. The Atlanta Federal Reserve maintains a product known as GDP Now, which estimates current core gross domestic product. And the latest estimate suggests that during the current quarter, the U.S. economy is on pace to grow 2.9% on an annualized basis. None of these are indicia of recession. Indeed, indication of an economy that continues to maintain plentiful momentum. And of course, certain parts of the economy have outperformed others. And at the heart of that statement is the American consumer, who's been on a spending tear. Monthly retail sales. Got the data for July and August. The consumer has been on a spending tear. Now, some of that, of course, is because of inflation. So they're spending more for what they're buying. You know, I was being introduced by someone who pointed out very nicely, costs have gone up. That's true across the economy. And we'll talk about inflation today. There's no question about that. But the consumer has spent right through that inflation. They've continued to buy. Oh, every once in a while you'll hear stories about the occasional customer distributor at Starbucks. Starbucks just replaced its CEO, as you know. Actually, the previous CEO looked a lot like me, Lakshman Narasimha, so I feel badly for him, but he was replaced by Brian Niccol coming over from Chipotle. The CEO of Five Below just left his job, just walked out the door. Things were so tough there. So there's that. But if you look at the macroeconomic data, the consumer has been spending, and in fact, much of the growth in consumer outlays recently has not been on retailed items here depicted, but on services, things like travel. So occasionally America will set a new record for people passing through TSA checkpoints on a single day. They're spending on Beyonce concert tickets. They're spending on Taylor Swift concert tickets. In August of 2023, the average Taylor Swift concert ticket purchased on resale, and that's how people buy them on resale, sold for $1,619 per ticket. She sold at football stadiums in major cities multiple times in the same week. She just toured Australia, where the Australian government thanked her for improving their economy. She generated about $300 million of economic impact in 4 days. She's not merely a musical phenomenon, she's an economic one. And I would say to you as an aside that this thing between her and Travis Kelce is pretty much the greatest thing ever. This is fabulous, it's fantastic, it is phenomenal, it is not at all annoying. And what you have here is this hunky athlete from Kansas City Chiefs, 3-time Super Bowl winning tight end Travis Kelce, in a relationship with the savvy singer-songwriter Taylor Swift. There are pictures of them kissing on the internet. Now, some of that's artificially generated, but the point is, this has many Americans aglow, abuzz, and hopeful, and there's reason for hope. Because unlike many stories, this one stands to end well, because when that breakup occurs, and it will occur, she's going to leave him. She can do better than a Kansas City Chief. Anyone can, everyone should. The music is going to flow, and I, for one, cannot wait. Now, I want to make the case that the consumer cannot continue to spend in this fashion. And at the heart of that statement is American demography. New York Federal Reserve Bank data, just breaking down American wealth by percentile. So what I'm doing for you here is I'm just stacking the most affluent households in America down through the least affluent and just trying to figure out where the wealth resides. So if you look at that teal-colored slice at the top of the slide, that's the wealth controlled by the top 0.1% of Americans. So that's about 335,000 Americans. And that top 0.1% of Americans controls about 13.6% of the nation's wealth. Now, if you look at the balance of the top 10%, so that's that green slice below that, below the teal slice. So that's your 99th percentile to your 99.9th percentile. They control another 16.8% of the nation's wealth. Not making a political statement about that at all. Obviously, America is a phenomenally wealthy nation, just simply pointing out that the wealth is not evenly distributed. So the top 1% of Americans controls a bit more than 30% of the nation's wealth. If you look at the balance of the top 10%, so that's your 90th percentile to your 99th percentile, they control another 36.6% of the nation's wealth. So the top 10% controls almost precisely 2/3 of the nation's wealth. Down below is a brown segment. That's the wealth controlled by the 50th percentile to 90th percentile. So that's about 40%, that is 40% of the US population, and they control another 30.5% of the nation's wealth, which means that the bottom 50% of Americans controls 2.5% of the nation's wealth. Some of that wealth is in their homes. Some of these folks are homeowners. But by and large, they live on fixed incomes or paycheck to paycheck. Here's the good news about the economy. There have been a ton of paychecks recently. This is from the JOLTS, the Job Openings and Labor Turnover Survey. In July, 7.7 million available unfilled jobs in America. It is still the case that we have more job openings than unemployed people in America, though the gap has shrunk massively, as you can see in recent months. The economy is slowing. I'm going to make that case later on in the presentation. Nonetheless, we still have more job openings, available unfilled job openings, than we did pre-pandemic, when the economy was considered to be very, very strong. Back then, we had a 3.5% rate of unemployment. At that point, a 50-year low. We had about 7 million job openings. And for many of the employers here, I think you might agree that the number one challenge during this period of economic expansion has been finding the workers to do the work, do the job, retain them, afford them, recruit them. The labor market is still quite tight, it's still quite strong. And so that virtuous cycle in which consumers are spending and impact employers are hiring remains in place. And of course, one of the things that we observed in 2023 was that labor flexed its musculature. So we saw strikes among actors and writers, for instance. That's one of the reasons we did not have an early summer movie blockbuster. Last year we had Barbie and Oppenheimer quite early in the summer. This year it took a long time to get that blockbuster. Thankfully, we finally got Deadpool and Wolverine, and I thank both of them for that. But it took a while because we're not generating as much content during the strikes. We saw strikes among UAW members, of course. Now, some negotiations did not end in strikes. I'll give you an example. The negotiation between United Parcel Service, UPS, and the Teamsters Union, that produced a 5-year agreement, and during the 5th year of that agreement, the average full-time UPS truck driver will be earning $170,000 per annum. That's $170K. That's wages plus benefits plus $170K, forcing people like myself to ask the question, how do I look in brown? And based on the app, spectacular. But the point is that that is great for consumption when we've seen that kind of wage growth and job creation over time. And indeed, when a nation enters each and every month with plentiful numbers of job openings, it is quite likely that that particular month is going to end up adding jobs, which is exactly what America has done since December of 2020, a COVID-intensive month. So this is a monthly job change in America, as measured by the Bureau of Labor Statistics. So whether bridge collapses, or wildfires, or hurricanes, or whatever it happens to be, congressional elections, America's managed to add jobs every month since December of 2020. In August, according to the preliminary estimate, the nation added 142,000 jobs. Now, of course, you'll want to take these numbers with a grain of salt, maybe even 5, 6, or 7 grains of salt. You may have heard recently the Bureau of Labor Statistics downgraded its estimate for job creation through the year ended in March by 818,000. And the error band around that 142,000 estimate for August is 130,000 in each direction. Nonetheless, the markets take these numbers very seriously. The markets move when that preliminary estimate comes out, one way or the other. And so that's the latest estimate. And so the labor market continues to function quite well, ostensibly at least. And of course, certain regions of the country have been performing better than others. So this is percentage job growth for the 25 largest metropolitan areas in America, February of 2020, why that as the baseline. That is the last month before we shut down the economy. Through August of 2024, the last month, of course, which we have data. So if you do that comparison, this is about 4.5-year period, February of 2020 to August of 2024. In fact, it's precisely 4.5 years. The left-hand column is populated by the regions adding jobs at the fastest clip over the last 4.5 years. There's a neat correspondence between population growth and job growth. And in recent years, No region of the country has added more people in absolute terms than the Dallas metropolitan area. Booming. Flat land, very developable, lots of rainfall, favorable zoning, lots of infrastructure leverage, so on and so forth. And it's the American South. That's where the population growth has been, that's where the job growth has been. Dallas, Tampa, phenomenal market. That Tampa, St. Petersburg, Clearwater market is just, it's fabulous. It's very well led. San Antonio, Charlotte, Orlando, Phoenix, Houston, Atlanta, Miami, the American South, the New South. In the right-hand column is a number of the larger markets in the Northeast, of course, New York, Metro, Boston, Washington, my town of Baltimore, and also you'll see some Midwestern markets there, including the biggest markets like Minneapolis, Detroit, and Chicago Metro. Less population growth, less job growth. Now, this slide is, I think, quite interesting, but the next slide is far more important macroeconomically. Same 25 major metropolitan areas, but these are unemployment rates. And one of the things that you'll note is that these unemployment rates, and this is for July, the last month for which we have subnational unemployment rate data, is that some of these unemployment rates are really starting to take off. Labor market's weakening. For instance, if you look at the bottom of the right-hand column, Detroit Metro, 6.4%, that's not especially low. Chicagoland, 6.2%. Some of the Southern California markets at or near 6%. So that's the question, really. Can this recovery sustain itself? And of course, we've said that the consumer has been really on a tear, but can they continue to be? Will they continue to be? And that brings us to the next part of the presentation. The bad, is this recovery sustainable? What are the vulnerabilities to the current economic expansion? And again, at the heart of that question is the American consumer. You cannot have an economic downturn unless the consumer participates. For they are 70% of aggregate demand. So let's start this part of the story off with personal savings as measured by the San Francisco Federal Reserve Bank for the United States. So the green line there below measures personal savings in hundreds of billions of dollars. And you can see a reasonably smooth trajectory in personal savings as we move toward the pandemic. But then, of course, the pandemic changes everything. Because during the pandemic, people started receiving stimulus payments. Not everybody, but almost everybody. Of course, small businesses and other businesses receive paycheck protection. Many people experienced meaningful wage increases during the pandemic. And of course, we thank them for working through the pandemic, whether at pharmacies, construction job sites, or elsewhere. So for many households during the pandemic, income was actually going up, precisely as expenditures were going down, because they weren't taking vacations. They weren't seeing movies or going to plays. They weren't seeing Beyonce or Taylor Swift or even Ice Spice or SZA. And so according to the San Francisco Federal Reserve Bank economists at the pinnacle, they amassed about $2.1 trillion in excess savings, meaning savings above and beyond what they would have saved but for the pandemic. According to those same economists, by the middle part of this year, all of those savings had evaporated and then some. $2.5 trillion drawdown in savings. Now, as those savings were being spent, of course, it juiced the economy. Third quarter of last year, 4.9% growth on an annualized basis. Fourth quarter, 3.4%. Consumer was on a tear. And they have remained that way for the most part. But now the pandemic-era savings are gone. And so what are you left with in many instances? A consumer who has spent down their pandemic-era savings and continues to face high and rising prices. Inflation is measured by the Consumer Price Index. 12-month percentage change in prices is measured by the CPI. There are two lines here. The dashed green line is your overall rate of inflation. And what this says is that between August of 2023 and August of 2024, overall inflation running at 2.5%. You say, Anirban, that's partial victory. Because back in June of 2022, inflation, the pace at which prices are rising over any given period, was up 9.1% year over year. Now we're down at 2.5%. And if you do the simple extrapolation, 2%, the Federal Reserve's target, must be right around the corner. Now, if you strip out food and energy prices, you get the so-called core rate inflation, all items less food and energy. Many economists look at that, including myself, and that's at 3.2% year over year. If you look at more recent data, by the way, like 3-month moving averages or 6-month moving averages, you get inflation that looks a lot closer to 2%, which is, of course, what helped empower the Federal Reserve to reduce interest rates by 0.5 percentage point last week. We'll talk more about the Federal Reserve later on in the presentation. But again, the effect of this is cumulative because prices are still rising. I mean, the pace of increase is slow. That's true. But prices are still rising. If I said to you that Harvard University increases tuition just 3%, you say, well, big deal. Their tuition was so high to begin with, or Stanford, whomever. And that's the same thing. We have base effects. Prices are already quite high, and they keep rising. So this is year-over-year percentage change in inflation, as measured by the Consumer Price Index. The headline numbers are repeated down below for you. 2.5% overall inflation, Strip out food and energy prices, the so-called core rate inflation, you get 3.2%. But categorically in green, you see some interesting things. Now, if you need another reason not to smoke, here's one. Tobacco and smoking product inflation up 8.4% over the past year. It got even more expensive. After that, transportation services, well, of course. Of course, shipping costs went up. If you're going to pay the UPS truck driver that level of money, that kind of compensation, that money has to come from someplace. Somebody's going to have to pay for that. I'm not begrudging the UPS truck driver that level of compensation. Not at all. These are very special people. They have to be able to drive a large vehicle, park it. They have to lift heavy objects all day long, as much as 70 pounds, and pass a drug test. Most Americans cannot do all of those things. But UPS workers can. And they're compensated handsomely for it. You also see categories like food and so on, still prices rising. And again, the effect of this is cumulative. Because this burst of excess inflation, meaning inflation above the Federal Reserve's 2% target, manifests itself during the early stages of 2021. That's when inflation really takes off. So if I take you back to May of 2020, why that month? That is the first month of the economic expansion. America loses 22 million jobs in March and April of 2020. We start to add back jobs in May of 2020. So if you look at price levels as measured by the Consumer Price Index back in May of 2020 and compare those to August of 2024, again, obviously last month for which we have data, headline numbers down below, overall inflation running at 23% in about 4.5 years in a country that aspires, actually a little bit more than 4 years, 4.25 years, in a country that aspires to 2% inflation per annum. Strip out food and energy prices still lofty 20%. Categorically in green, energy prices up more than 50%. Transportation services prices up 45%. Food prices up 23%. Shelter up 24%. And I'll tell you, it's that grocery bill that has a lot of people upset. Oh, they complain about electricity bills, especially in this part of the country. Oh, and they complain about rent. But it's groceries that I think has people most upset of any single category. One of the things I do, I talk to a lot of Americans about the economy. Often when I'm taking Ubers and Lyfts. And I'll take, after this presentation, and I'll Lyft back to I take Lyft because I'm trying to keep them alive to compete against Uber, but I'll take a Lyft from here to the airport here. And you may know, those of you who take Ubers and Lyfts, that as a passenger, you rate the driver. You may be less aware that the driver rates you as a passenger. And I have become very recently privy to my passenger ratings, and they're incredibly low. Just abysmally low, and you say, well, that makes sense, sir. We've seen you speak for about 20 minutes now. I think this is beyond my personality. There's something else afoot, because I take every Uber or Lyft trip as an opportunity to interview an American. And I'll ask them questions like, hey, and I'm doing this from the back seat, obviously. Hey, how much do you really make doing this on an hourly basis once you factor in depreciation and insurance? What's your highest level of educational attainment? What other options did you have? Does your family approve? Do you have a girlfriend? Why would you choose this vehicle in particular? And apparently, these questions are off-putting. But when you ask people about the economy, they will tell you the number one thing that has me upset is right here. I can't keep up. This has a lot of folks in Washington, D.C. surprised. Say, look, we got 4.2% unemployment in August, 7.7 million job openings, stock market's at record highs. The Dow Jones is at 42,000. I'm speaking to you. S&P is still about 5,700. NASDAQ is this close to 18,000. What are people complaining about right here? Can't keep up. But they want to keep up. Because once you establish a certain standard of living, even if it's for ostensibly temporary factors like stimulus payments, you don't want to give that up. But if the pandemic-era savings are gone and the prices keep rising, what do people turn to? Of course, they turn to the credit card. New York Federal Reserve Bank data, credit card data for the US, and it's spiking. Now, many economists will say this Basu is making too big a deal out of this because he has not adjusted these data for inflation, and I have not. I could, but I haven't. It is still the case, however, that more Americans are suffering difficulty fulfilling their basic economic or financial obligations. This is percentage of balances 30-plus days delinquent by loan type, missed debt payments. The green line there is credit card delinquency. It's rising. Now, again, some economists might say, well, again, he's making too big a deal out of this. Yeah, credit card delinquency is rising, but off a very low level. That we've had other moments in history when credit card delinquency was higher than this and when the economy is actually quite strong, so it's not a big deal. I view that as the optimistic perspective. But I am no optimist. I am among the most pessimistic people you'll ever encounter. Didn't have a girlfriend in high school, didn't really have one in college. I'm from Baltimore. So I expect bad things to happen all the time. And when I look at that, I see that trend is ominous. And by the way, not in isolation, the yellow line is auto loan delinquency. It's rising. Toward the bottom in brown, mortgage delinquency is rising now off, again, an absurdly low level. Fair enough. But if we're starting to see some people miss their mortgage payments, that tells you that there's some building economic stress among American households, and that stress is moving up the socioeconomic ladder. We're not talking about homeowners. And so I'm suggesting this, not that there's necessarily going to be a recession anytime soon. No, I'm not saying that. What I'm saying is that the consumer cannot continue to spend in this way, and therefore, all things being equal, one might expect the economy to slow further from its current trajectory. That's all I'm suggesting. Now, this behavior by consumers has surprised me, and I admit that. The economy vastly outperformed my expectations in 2023. I own that. And it has a lot to do with the consumer outspending my expectation. What was I thinking? What I was taught in school, one of the things I was taught in school, is that the most important price in the economy is the interest rate. It's the most important impetus or stimulus to which people respond. So this is the commercial bank interest rate on credit card plans. And it's spiked over the last couple of years as the Federal Reserve maintained a tighter monetary policy. So what was I thinking naively? That the consumer, faced with these higher borrowing costs, would take on debt less aggressively, spend less aggressively. No, they spent right through it. Which again, great for retail sales and job growth and GDP and all those kinds of things, but now creates a susceptibility or vulnerability that previously did not exist. Now, again, this has been engineered. This was completely planned. These tighter credit conditions, these rising delinquencies. A group of policymakers in Washington, D.C. wanted to weaken the economy, to bring inflation down to that 2% level, their mandate, their measure of price stability. And the principal mechanism for doing that is right here, the federal funds rate, also known as the Fed funds rate, aka the overnight bank lending rate. This is the rate at which banks can borrow from one another overnight. And why would a bank do that? Because banks have a certain amount of reserves inside the bank to make loans outside of it, and occasionally banks run up against that constraint. When this rate is set at a low level, banks are more likely to borrow from one another, thereby shore up their reserves, thereby lending more aggressively in the economy. When the rate is set at a high level, banks are less likely to engage in such behavior. And this is, again, the principal mechanism by which the Federal Reserve influences economic growth, and it's a byproduct of inflation. Now, again, this burst of inflation shows up in early 2021. The Federal Reserve sees that in the data. We all do. And of course, we experience it in various ways. The Federal Reserve responds to that burst of inflation by doing precisely nothing about it. They view that inflation to be transitory, a word now well known to Americans. A synonym for transitory is fleeting. They think it's almost purely supply chain driven, that as supply chains normalize, as employees are rehired by employers, supply will rise up to meet demand, and inflation just naturally baked to that 2% level we'd enjoyed prior to the pandemic for many, many years. In fact, their forecast for interest rates going into 2024 was 0%. They thought inflation was going to fall and they would not have to respond to it. Now, after about a year of doing nothing about this, they realized this is not transitory. This inflation story is real. There's still some lingering supply chain effects out there, and people's expectations regarding inflation have changed. They've built them into their wage requests and their pricing models. So starting in March of 2022, March 17th of 2022, they start to raise rates, but even then they only dip their toes in inflation-fighting waters, that day raising rate 0.25%. But next meeting, 0.5%. Next 4 meetings consecutively, each meeting 0.75% each meeting. Then back to 0.5%, then 0.25%, then 0.25%. May 3rd of last year, 0.25%, pause in June, July 26th, 0.25%, pause for 8 meetings, and then last week, cut half a percentage point, which is what you see on the slide, that cut. But the point is, you look at that cut and you say, everyone's so excited by that 50 basis point cut, it's small potatoes compared to the increases that we've seen. So interest rates are still high. Monetary policy is still restrictive. And I'm going to make the case that this economy still has some further slowing to do, not just because of the consumer, but other factors. And part of the consideration is economic theory. Now, I won't go through all of this, but I want to pick out this first bullet for you, which is a quote from the highly respected, highly regarded President and CEO of the Atlanta Federal Reserve, Ralph Bostic, who says, quote, "A large body of research tells us it could take 18 months to 2 years or more for tighter monetary policy to materially affect inflation." You say, Anirban, of all the things you have said, that is the most nonsensical. Because you yourself just said the Federal Reserve has been raising rates since March of 2022, and that over an overlapping period, inflation went from more than 9% to, by some measures, less than 3%. Clearly, tighter monetary policy has had a material effect on inflation. There's been some effect. I'll give you that. But I think there's actually been a factor that's been even more important in shaping economic outcomes the last 2+ years. And what is that factor? Improved supply chains. Now, I'm not saying they're perfect. I can see what you're seeing. I can see what you're seeing in the South China Seas and the Chinese Coast Guard and so on and so forth, and the mayhem there, or the Red Sea and the Houthi rebels, Somali pirates, issues with the Suez Canal, issues with the Panama Canal, bridge collapse in Baltimore, lockout of railroad workers at 2 Canadian railroads. I see it too. But supply chains are more reliable as a general proposition than they were in late 2021. And here's what happens economically as supply chains improve in the context of unmet demand. Let us take new cars as an example. For a while, Americans were having a tough time finding new cars on dealership lots. So what did they do? They bought used cars. What happened to the price of used cars? Skyrocketed. But then new cars began to show up on dealership lots. All of a sudden, Americans had optionality. All of a sudden, used car prices were not rising rapidly. In fact, they've fallen about 10% over the past year. Moreover, there was frenzied waiting demand for those new cars. So as they hit the lots, they flew off the lots. So what do you get as supply chains improve in the context of unmet demand? You get tons of transactional volume as that supply meets that waiting demand, and you get less inflation because you have less scarcity in the economy. My view is that some of the big effects from these higher interest rates we've been living with have yet to pervade the economy. Those so-called lag effects from higher interest rates. It's exactly what you saw, by the way, before the 2008 downturn. The Federal Reserve was raising rates in years like 2004, 2005, 2006. They start to actually cut rates in 2007, but then the crisis hits us in 2008. Why? Lag effects. I'm not saying we're going to have a great recession, by the way. I'm not saying that at all. I'll give you my forecast later on in the presentation, and I will leave some time for Q&A, by the way. I'm just simply saying there's some more vulnerability out there, even as people are very excited, including equity market investors, in the latest round of interest rate cuts. Now, I'm not saying, again, those interest rate moves have had no effect on the economy, not at all. Here are two interest rates of interest. 30-year fixed mortgage rate is in blue, 50-year fixed mortgage rate is in green. These data come from Freddie Mac. And as of the last week, the average 30-year fixed mortgage rate in America, 6.09%. You say, Anirban, assuredly, you're not going to make a big deal as 6.09% 30-year fixed mortgage rates, are you? Because I can remember when mortgage rates were 18%. I can remember when they were 15%, fair enough. But to millennials and Generation Z, the youngest members of our workforce, these rates are preposterously high. And that's who's really dropped out of the U.S. housing market from a purchasing perspective that would be first-time buyer, frustrated by lack of inventory, high prices, and by their standards, extremely high borrowing costs. Now, as I move toward the tail end of this presentation, I'm going to show you a number of leading economic indicators because I want to pivot from a discussion of what's been happening to a discussion of what's likely to happen going forward. Here's a leading indicator. This is the U.S. Mortgage Loan Applications Composite Index. Mortgage applications are a leading indicator because that is the first step in the journey to the settlement table. So this is the first indication that somebody out there now seeks to transact. But mortgage applications are down about 75% from their 2021 peak. So you've got fewer ready buyers out there. The population of people ready to transact in the housing market has shrunken dramatically. It's a Anirban. If that's the case, housing markets must be in terrible shape. But by many measures, as you know, it is not in terrible shape. Take, for instance, U.S. home sales prices as measured by the S&P Case-Shiller Home Price Index. Home sales prices in America have never been higher, which, by the way, gives me some credibility with respect to my statement that higher interest rates have not really pressed down inflation. The one price you would expect to be most impacted by higher interest rates is right here, home sales prices, record highs. You see the increase in home sales prices during the pandemic and early stages of recovery? That's a 35% increase in U.S. home sales prices in a very short period. And of course, from the pandemic, our behavior changed. We want to take advantage of the lowest mortgage rates in the history of this country. We want more square footage because we're spending more time at home. We want room for home offices and home gyms, and one room just for the Peloton. Anytime you see a Peloton advertisement, the only piece of furniture in that room is the Peloton. That's how we Americans seek to live. You buy a Peloton, you put it in a room, you lock the door. And then when people visit, you show them the Peloton, you splash some water on it to make it look like it's been used. We all know that story. We get it. We're exceptional people. But then the pandemic ended and mortgage rates took off. So why was I thinking naively that we'd give back a significant chunk of these home sales price gains? And you can see it happened for a few months, but not very long and not very far. What did I fail to fully appreciate? I appreciate, I think, the fact that there are fewer buyers out there. What I failed to fully appreciate was the fact that there are so few sellers out there. Because if you have fixed in at a 2.75% 30-year fixed in Duluth, Minnesota, or Kankakee, Illinois, or wherever, where are you going? You're not going anywhere. You're going to have to be carted out of that house. You're going to leave that house in an ambulance. And so not many buyers, not many sellers, high equilibrium sales price. Now, of course, this affects construction. So another leading indicator, this is U.S. residential building permits. It's a leading indicator because if you're a builder, you've got to pull a permit before you build. The orange line there is single-family building permits. And you look at that and say, that doesn't look so bad. If millennials, our most populous generation, are having a tough time transacting for various reasons, why are single-family builders still pulling so many permits? Because there's so few existing homes for sale. Single-family builders are spying opportunities to meet unmet demand, including among millennials. The average size of the American new home is shrinking quite dramatically right now as home builders try to meet millennials where they are financially. Actually, the loss of momentum here is in the multifamily category. That relates to future apartment construction. That's the green line that you see there. So, but how is that possible? If the millennials are having a tough time transacting along with Generation Z, the newest generation in the workforce, they have to live someplace, right? They can't live with their parents forever. They can try, but they shouldn't. So they're going to be leasing apartments. I would think under such circumstances, multifamily building permits would be quite strong, but they're not. Why? Because increasingly, developers are having a tough time lining up project financing. And sometimes they can line up their financing, but the interest rate they're being offered is so high, their pro forma no longer pencils out. And even on a pro forma, you can only raise your rent so high. And this dynamic, this tighter financing condition, by the way, about a year and a half ago, we suffered the failures of Silicon Valley Bank, March 10th, Signature Bank, March 12th. And though that had very little to do with real estate, bank credit has become more pessimistic, more difficult to access, especially in real estate categories. And regulators have become more aggressive in scrutinizing bank balance sheets and the risk that they're taking onto those balance sheets. So, and this dynamic extends beyond the multifamily market into certain commercial real estate segments. Another leading indicator, this is the Architecture Billings Index. And of course, construction is material intensive, as it turns out. But Architecture Billings Index, you see the 50-yard line running west across that slide? Any reading less than 50 means that architects are less busy this month than they were last month. Look at the chart, 12 straight months, architects less busy. Why? Project financing again. Now there's more to it than project financing. There are certain segments of commercial real estate that are very, very weak, and that takes me to the ugly, the US office market. Again, last year the US economy grew 2.5%, and we've continued to expand this year. Nonetheless, based on CoStar data, the US office vacancy rate ended the second quarter of this year at around 13.9%, and it's rising. And that 13.9% that you may or may not be able to see on the slide, depending on where you're sitting, is a lie. Way more than 30.9% of our office space in this country is vacant, but it is not considered to be vacant because it is still leased. But as these lease renewals come up, you'll continue to see upward pressure on office vacancy rates. Not everywhere. There's suburban markets out there that are in quite good shape from an office market perspective, other markets. Much of the pain is in older central business districts and older buildings therein, Class B and Class C properties. I delivered a presentation recently in Harrisburg, Pennsylvania, because that's how glamorous my life is. And I was speaking to a group of commercial real estate developers, and they said, Anirban, we need to build more office space in central Pennsylvania because we haven't built much in the last few decades. And we've got major healthcare systems like Geisinger and others that are expanding and need such space. Okay, fair enough. But here's the thing, in many other parts of the country where the market is in very bad shape, you've got building owners who are losing tenants, suffering higher vacancy, losing rental revenue, and now have to refinance their mortgage. That's that debt maturity wall that everyone talks about. $3 trillion in commercial real estate debt matures over the next 5 years. Who's going to want to touch those buildings? The ones that are suffering poor performance. Who wants to be exposed to that kind of risk? I'll give you an example. There was an article about 3 months ago in the Wall Street Journal featuring downtown St. Louis, a beautiful historic American city. And the tallest building in downtown St. Louis is the 44-story AT&T building. In 2006, that building sold for $205 million. It just sold for $3.5 million. And you see these stories across the country, by the way. Los Angeles, Washington, my town of Baltimore, so on and so forth. And somebody takes that loss. Now, it could be a series of building equity holders, people buying those buildings over time and suffering loss of value. But it could also be a bank, and that's why I think I really care about macroeconomically. I care about the building owners, obviously. But the bank's exposure to that, particularly certain regional banks that specialize in commercial real estate lending, that's where I see some issues. We haven't seen them yet, I admit that. Though New York Community Bank Corp, you might remember a few months ago, ran into some trouble because of its exposure to real estate in Manhattan. Steve Mnuchin, the former Treasury Secretary, helped to recapitalize that bank. But the point is, those risks are out there, and that's another reason why I'm somewhat pessimistic about the outlook. These are the highest downtown office vacancy rates in our country as of the second quarter based on CB Richard Ellis data. So at the top of the list is San Francisco, screaming towards 40% vacancy. And by the way, the company formerly known as Twitter, X, is moving its headquarters out of downtown San Francisco. Be another blow to that community. Denver, Oakland, Portland, Los Angeles. I mean, Los Angeles is a massive office market. We're 31% vacant. There's a lot of bank exposure to these things. That's my point. It's another risk that is out there. So that takes me to the final part of the presentation, the forecast. This is Clint Eastwood from the Dirty Harry films. There are 5 Dirty Harry films. The first one shows up in 1971. The character's name is Harry Callahan. In that movie, Harry Callahan has a partner. The partner's name is Chico Gonzalez. And Chico Gonzalez is played by an actor who would later show up during the Seinfeld episodes playing the part of Poppy, the unhygienic restaurateur. Just a movie and TV history in which apparently none of you has any interest. So let me again continue on with this story. So iron ore spot price. Iron ore spot price. I know there's some interest here in metals prices. Iron ore spot price. So it's down 9.3% year over year. Still higher than it was by about 14% compared to February of 2020. But the momentum is definitely to the downside for many of these metals. The same is true, by the way, if you look at the producer price index for steel mill products. So the producer price index is a reflection of what sellers are receiving into the form of price. That price is falling. I just delivered a presentation at a steel conference about 4 weeks ago in Atlanta, Georgia. Lots of pessimism there, and I'll talk about some of why that is, about steel prices going forward. Lots of people out there, of course, want to support the proposed merger between Nippon Steel and U.S. Steel to help recapitalize U.S. Steel, maybe actually shrink some capacity in the marketplace, because there is downward pressure on prices. You can see if you look at, and you may not be able to see this very well, so let me walk through this. These are metal price forecasts from the World Bank. The green colored bar there is 2024 year-over-year percentage change, expected change. The blue colored bar there is 2025 year-over-year expected change. So aluminum expected to go up 4.3% next year in price. These are just expectations for the World Bank. They could turn out to be wrong, obviously. Copper prices, which have not been that strong, around $4.35 a pound this morning, down 1.1% next year. Iron ore down 4.5% expected next year. Lead expected to fall 2.4%. Nickel expected to rise 5.9%, but after falling 21% this year. Tin expected to rise 4.1% this year, 3.7% next year. Zinc down 6% this year, up 4% next year. But you can see that there's some tumult in some of these metal pricing markets. And again, part of this maybe has to deal, these are iron ore prices historically projected by the World Bank, just to show you what their trajectory is. And you might note that prices actually by next year are expected to be actually less than they were pre-pandemic, or at least less than they were in 2020, I should say. But there's some downward pressure here. And again, that's one of the reasons we care about the U.S. economy, the largest economy in the world by far. I mean, it's incredible, right? The Americans, quarter of global output is generated here in this country, just remarkable. So these are major forecasts for U.S. economic growth. The green colored bar here, let me be clear, is 2023 history. That's actual. That's actually what happened. And 2024 is the blue colored bars, the forecast for the current year. But wherever you look, it's around 2.5% to 2.6%, whether it's the World Bank, International Monetary Fund, or Organization for Economic Cooperation and Development. So again, the economy is fine here. So then why this downward pressure on metals prices if the U.S. economy has held up much better than anyone expected? Well, I should probably start with this, China. Again, the yellow bar here is 2023 actual, 2024 is the blue bars, and it's just a weakening economy. And that's if you believe the data. There's actually evidence of deflation in the Chinese economy. There's lots of issues here because, as you know, the Chinese are in the midst of a fairly significant real estate and debt crisis related to that real estate. Historically, what would the Chinese do to get out of that crisis? Export their way out of it. Sell more manufactured items to the rest of the world to bring in the revenues to deal with some of these domestic issues economically. But the rest of the world is pushing back on those exports, obviously. The Canadians, of course, just slapped on further tariffs on steel and aluminum coming from China. So some of the Americans are contemplating more tariffs on steel and aluminum from China because the Canadians and the Americans and the Europeans and others don't want to have to retire their domestic production capacity simply because the Chinese have excess production capacity of steel and aluminum, that kind of thing. So they're trying to push back on the importation of those items, which of course continues to render the Chinese economy that much weaker and maybe actually has the unintended consequence of putting even more downward pressure on some of these metals prices. At least that's the thesis. Another leading indicator, this is the Conference Board's Index of Leading Economic Indicators. This is for the U.S. economy. It's 10 leading indicators all bundled into one composite index being graphed for you here. It's an index that predicted the 2001 recession, predicted 07, 08, 09. It's not telling us something more wicked this way comes. And again, my thesis is that this is the index picking up the lag effects from those higher interest rates that we've been living with, and we continue to, despite the fact that the Federal Reserve is now in its rate cutting cycle. This is the Somru recession indicator. So yes, unemployment fell last month to 4.2% from the previous month, 4.3%, but in general, unemployment has been on the rise. The cyclical nadir for unemployment had been 3.4%, it's up to 4.2%. Now this rule was created by a very clever economist, Claudia Sahm, who in 2019, while working at the Federal Reserve, generated a rule, and I've actually summarized the rule for you in that text box, but I won't go into that. It gets at how rapidly unemployment is rising. And unemployment begets unemployment. So if the factory up the street lays off workers, the restaurant down the street, the retailers down the street will also lay off workers, which will feed more layoffs at the car wash or whatever it happens to be. That's the notion. And when unemployment starts to rise too quickly, that can create a disorderly labor market. Now this index is structured such that any reading above 0.5 percentage points is a recession trigger. The last reading was 0.57 for August, and if you apply this data back to the 1970s, it has been coincident with every recession since the 1970s. So we're not out of the woods economically yet, even though many economists are saying soft landing, soft landing, soft landing. By the way, the yield curve is still inverted. So again, two interest rates of interest. The yield or the interest rate on the 1-year U.S. Treasury is in green. The yield or the interest rate on the 10-year U.S. Treasury is in blue. Now typically, you would expect the interest rate or yield on a 10-year instrument to be meaningfully above that relative to a 1-year. When you buy a 10-year U.S. Treasury, you're lending to the federal government for a decade. You're not going to see your principal for 10 years, assuming you hold that bond to maturity. You're becoming highly liquid in the process. You're going to demand more interest from the marketplace because of your patience. Conversely, when you buy a 1-year U.S. Treasury, you're lending to the federal government for 12 months. You'll see your principal back in a year, risk-free. Not being so patient, not being so liquid, less interest. But occasionally, the bond market goes topsy-turvy, upside down, inside out, Diana Ross. And the yield on the 1-year goes above the yield of the 10-year. That's an example of an inverted yield curve. Now, these gray shaded areas are periods of recession dating back several decades. So when do you see that green line go above the blue line, that example of yield curve inversion? Just for the 1970 recession, before 73, 74, 75, before 1980, before 81, 82, before the 1991 episode, before 1991 episode, before 2001, before 07, 08, 09, not so much before 2020, that was called something else, but we're inverted today, for instance. The yield, as I got up here on the 1-year Treasury at 3.96%, the yield on the 10-year around 3.76%, inversion. It's been inverted for the last couple of years. Has been a nearly flawless predictor of recession for decades. So I still think that there's a possibility for further economic weakness in front of us. And that leads me to my final slide. Go where we're looking and look where you're going. That's a line from a more recent Clint Eastwood film, 2021's Cry Macho. Was not a box office sensation by a stretch of the imagination, but was a critically acclaimed film. And this is a film that not only does Clint Eastwood act in, but he also directs and produces. The gentleman has more than 40 directorial credits to his career. He's one of America's most prominent directors and movie composers, composing the scores of movies like $1 Million Baby and Mystic River. Mystic River, as you know, a very sad movie starring the likes of Timothy Robbins, Sean Penn, and Kevin Bacon. So in any case, the gentleman, by the way, was born on May 31st of 1930. So as this movie opens up, he's 91 years old. I mean, he's old enough to be president. I mean, just to give you some sense, he's been around. We're a deeply indebted society currently facing high borrowing costs, and that's what makes me pessimistic around the near-term outlook. Geopolitics and federal elections don't help, so it's additional concern, distraction, risk. And as you know, the geopolitics are spreading, especially in the Middle East more recently. And the markets haven't really experienced the brunt of that, right? The stock market's at record highs. You would think the world was in great shape. It's in quite rough shape, as you know. So it'll come nearly after a year after I initially anticipated, but recession is coming in 2024, 2025. I actually don't think recession is coming in 2024. I just put it up there just so if it were to happen, I could say, hey, I said it was going to happen. I really think it's much more likely that in 2025 at some point, you'll see what at that point will be unanticipated economic weakness. So just watch for that, and that, of course, can impact investment recovery as well. And with that, let us go. I hope I've left some time for Q&A. Thanks a lot for the opportunity. It's been a privilege. And I actually, as it turns out, have left some time for questions and answers. So are there any questions from this audience whatsoever? There's a mic right there. It's going to move around. Are there any questions? None? Oh, yes, miss.
Hold on. Oh, thank you. Thank you for your insight. Quick question. So I'm curious, what's driving unemployment if jobs are available? Because I feel like there's other factors underneath it. as an employer?
Right. So the question is a very good one, right? How can you simultaneously have so many job openings and have rising unemployment? How do you reconcile the two? Well, a couple of things to note. The number of job openings has been falling. Has been falling. But the other thing to point out is I think in many cases the job openings numbers are not as reliable as one would like. And why do I say that? Is I think a lot of employers out there are engaging in what I would call a moonshot, right? They're looking for that perfect employee with the perfect resume and a willingness to accept reasonable compensation. And if they can find that person, they'll fill that job opening. If they can't, they won't. So they're not necessarily as aggressive in their hiring as they used to be. In fact, one of the things that you'll hear from economists, and I could have pointed this out in my slides, is that the US hires rate has fallen pretty dramatically, right? The employers are holding on to their workers. So you don't see a lot of layoff activity, right? Initial claims for unemployment insurance have been quite low still. But what you see is that the pace of hiring has really softened. It may be that employers have become more demanding, and so, yeah, I got 7.7 million job openings, but it doesn't translate into a new job as easily as it once did because people are saying, I'm looking for somebody who really fits the role. I'm not just going to take anybody. The other thing is that we have some industries that have been struggling recently. At the heart of that statement is the manufacturing sector. By many measures, the U.S. manufacturing sector has been in its own recession. So a number of things happening out there, but there's one other factor I should have pointed out. The labor force is growing. So you may have heard this, I don't know, but there's been a fair amount of immigration in America. Have you heard that? And so you've got this surge of job seekers entering the marketplace, and that also, to be unemployed, you have to be actively looking for work. So you get this population surge. I won't talk about whether how we feel about that, but population has been surging, largely through immigration, and so that creates more job seekers, and that would also tend to drive up the unemployment rate. So, a number of factors. Any other questions here from this audience? There's a question right here, this gentleman. The mic is coming to you.
How do you think the upcoming longshoreman strike will affect your presentation today?
Right, so it's interesting, right? Because even as there's evidence that the labor market is weakening and that hiring is slowing, we still see still a fair amount of labor strife, right? So we have a strike right now. We've had a strike at Boeing, for instance, among mechanics, machinists, those kinds of folks. And now, and toward the end of this month, we might have a significant strike among the International Longshoremen's Association, ILA. And actually, that would affect the port in my city, Baltimore. We just opened up from our bridge collapse. So for us to now suffer a strike after that would be really, really painful. We're just trying to recover some of the volume that we lost, so to Norfolk and other ports. So what can I tell you? I think there is a mismatch here between reality and perception. I think, and I'm not criticizing anybody here, don't get me wrong. I want workers to prosper. That's critical for this nation to prosper. But I think that there is this impression among some union leaders or some labor leaders that the economy is as strong as it was 2 years ago or even a year ago, that the demand for workers is as high as it was back then, and that employers will simply cave into demands, as they did in 2022 and 2023 in many cases. But 2024 is a different year, and 2025 will be even more different. And so some of this labor strife will be met often with layoffs and furloughs, and that's exactly what we've seen at Boeing, for instance. It won't simply be met with, well, whatever you want, you get. So that's my impression. And so if job holders, job seekers, labor negotiators think, oh, this is the reality here, and they push for wages that are higher than the economy can support, that's another reason to believe that, one, there's some inflationary force there, right? When wages go up, prices go up. But the other thing is that can really weaken hiring even further because the employer is saying, that's not the reality anymore. I can't afford that anymore. I can't afford to do what you want me to do anymore. And so we see a lot more strife and a lot slower economic growth. So that's the ILA would be very damaging, obviously, because we're just getting through these supply chain issues. I will say that one of the things that you've seen is this surge in cargo imports at the Port of Los Angeles and Port of Long Beach. You've seen that, just unbelievable. Number of reasons for this. One is ships are no longer traversing that would have traversed the Red Sea. So they're coming, across the Pacific Ocean into the ports of Los Angeles and Long Beach. Second, a lot of retailers worried about this potential ILA strike have been buying their merchandise in advance of the holiday shopping season before and getting that shipped in before into their inventories before that strike would actually transpire. And so the effect might be less significant because people have known that this was a possibility for quite some time and have prepared for it to a certain extent. Nonetheless, it gives you some sense of the imbalance, I think, between perception and reality as it relates to the strength of the labor market. But any other questions here? There's a question over there.
Two questions. They're not really related to each other, though. The first one, dealing with the CPI slide that you had, I had heard on the news a while back that the government was tinkering with the market basket used to calculate the CPI. Is this true?
Yeah, the government, yes, it is true. The government constantly tinkers with the CPI, right?
Okay.
It has to. It has to, because before 2007, we didn't have any of these, right? There was no smartphone, so you have to tinker. The basket changes with technology, so you have to. There are all kinds of adjustments there. So I wouldn't read too much into that. Now you can ask the question, are the Bureau of Labor Statistics, the economists, making the right adjustments to the consumer price or that basket? That's fair. But the fact is that we've been making adjustments forever, because you can imagine the basket of goods now is much different than it was even a couple of decades ago.
Well, that's true. That's true. And then the second question, dealing with the housing starts that you had talked about and the permits being issued. I live here locally in Phoenix. And as interest rates are still sitting in the sixes, approaching 7% in most areas, and you talked about people not selling homes and whatnot. I see an incredible amount of growth here in the outskirts of the Phoenix Valley, but at the same time, there is almost no dip in prices. And if nobody's buying, common sense, I guess, or what used to be, would say, okay, well, the prices will come down until the market reaches an equilibrium, but that's not the case. And so my question is, do you see either a break in the interest rates coming down or a break in the prices to make houses affordable again?
Right, so the question is about the housing market, hopefully you heard it, but it's ambiguous. Here's what I would say is the way the market's going to play out. Mortgage rates are coming down. They've already started coming down. I saw that on the chart, right? They were roughly 7% a few months ago, now almost 6%. Okay. So they're coming down. They're going to come down even further, presumably, as the Federal Reserve continues to cut rates. I would expect another 0.5 percentage point decrease in 30-year fixed mortgage rates by the end of this year. So what 6.1% will be around 5.6%. That's my prediction, and then they'll continue to fall throughout 2025 as the Federal Reserve continues to engage in easier monetary policy. And I've already declared 2026 the year of the realtor, because by that point, you will have rates that are low enough that many Americans will say, look, I'm not going to get a mortgage rate as low as I have right now that I got during the pandemic ever again. I understand that. But I don't want to live in this house anymore. I'm trying to downsize or whatever it happens. I don't want, my spouse has a job in a different city. Whatever it happens to be, I have to move. I want to move. And now mortgage rates are low enough so that, yeah, I'm giving up this low mortgage rate, but the mortgage rate that I'm going to get when I buy the new place is not going to be so onerous. So that's going to create an abundance of homes on the for sales market, right? Inventory jumps higher. And all things being equal, higher inventory will mean lower prices. But at the same time, you've got all these millennials, again, our most populous generation, chomping at the bit to buy a home. So you've got lots of unmet demand to buy homes. So you can imagine the realtor is going to be rushed to the settlement table all the time, because that unmet demand to buy homes will meet that unmet need to sell homes. Come together, realtor wins, right? Bless you. So that's, I think, where we're headed. What that means for prices is ambiguous, of course, because when more supply, more demand, it's not clear where prices are going to go. As a practical matter, we have a structural shortage of housing in this country. So I would not expect a massive decline in home sales prices going forward, even as the inventory builds up. Any other?
Yep. You talked about the relationship between immigration and unemployment. Can you also talk about the relationship between the needed skill sets of the jobs for today and tomorrow?
Right, that's right. So, the question is, I know, by the way, that, not to credit or blame or anything, but under the Trump administration, immigration was much slower and unemployment fell to 3.5%. I mean, these things are not necessarily coincidental, but your question is about, I've been talking about the fact that we have seen the labor force grow and so on, but that doesn't really take into account the skill sets. And I would say in America, for the most part, we don't have a worker shortage, we have a skills shortage. And that's what you hear from employers all the time. That's why productivity in America typically doesn't grow very quickly, is because, you need people with skills. I mean, look at the U.S. construction industry. I do a lot of construction industry economics. My goodness, almost every project is behind schedule, over budget, so on and so forth. Why is that? You don't have enough carpenters. You don't have electricians that actually know what they're doing, right? I mean, you just don't have those skill sets. And many of the finest construction workers, and this is true actually in manufacturing too, are baby boomers. The baby boomers are by far the most successful generation in American history. They're fabulous economically, fabulous. And in terms of managing their household budgets, so on and so forth. But many of those work, I mean, the oldest of baby boomers is now approaching 80 years old. So they're retiring in large numbers, and that's where a lot of those skills, those production skills, manufacturing, construction, machinists, mechanics, that's where those skills reside. And younger workers have to replace them, but often they don't have the skills because we don't have that kind of industrial focus in our educational system that we once did. We don't have shop class anymore in most school systems. We once did. So a lot of things going on there, but America needs an upgrading of skills, that's for sure.
Yeah, and you actually hit upon my follow-up question. I don't know the legacy of investment from the Department of Education, but I'm sure there's a ratio between investment in education and skill sets.
Yeah, so here's the issue. That for many, many decades, Americans have been under the impression, and educators as well, that we're going to become just a service sector-oriented economy. That's all it is, service sector. And that to succeed in the service sector economy, you need to have the highest level of education attainment possible, right? You have to have a bachelor's degree, master's degree, whatever. You want to be in financial services, whatever it happens to be. Series 7 license, whatever it happens to be. But it's about education, credentials. And so we took shop class out of the curriculum, and we taught people to the test, right? You pass a series of assessments, you go to college, pass another series of assessments, go to graduate school, pass another series of assessments. So we left behind those blue-collar skills, right? The carpenter, electrician, or the HVAC professional. So they're not there. But the built environment can't improve without them. You can't invest in it, and so, or at least not efficiently. So what we need to do probably with respect to the Department of Education, and so I know the call is to get rid of it. No, I'm not saying that. But to try to rebalance things so that there's, again, a willingness and a capability to provide people with various pathways to prosperity. That it's not college education for everyone is the only pathway to prosperity, or college preparedness. There's another pathway. I mean, a good wellness country can make low six figures. There's nothing wrong with that. And if that's what interests people, then go for it. But they're not exposed to the trades early enough in life. They often happen upon the trades if they enter the trades, the skilled trades, accidentally. So my hope is that education systems around the country said, no, we have to have multiple pathways to prosperity, not just passing these various assessments that prove that somebody's ready to go to college. Any other questions here from this audience? Yeah, there's a question, a hand way back there, for instance. There's a hand over there.
Where?
And we still have time, so.
Very important question. What's your favorite Clint Eastwood movie?
Yes, I think 1968's Hang 'em High. Because in my own life, people have done me wrong occasionally. And I fantasize about exacting revenge on them in various ways, often involving weaponry. And that's exactly what Clint Eastwood does in that movie, right? People treat him wrong, and then he gets it back. And I just love that. And that doesn't mean I'm a very good person, right? You can tell that. But it's still very satisfying to watch him do that. So.
Another Clint Eastwood fan, thank you. Back to the Fed interest rates. If Chairman Powell let you choose this last rate move, would you have agreed with him? And back to one of your other statistics about the changing of the basket, in your opinion, is the Fed looking at data, or how much does politics get into that Fed rate?
Yeah, so, okay, with respect to Jerome Powell, attorney at law, by the way, not an economist, right? This would never have happened, this burst of inflation, if you had Paul Volcker, economist of the highest rank, Alan Greenspan, economist of the highest rank, Ben Bernanke, Nobel Prize-winning economist of the highest rank. No. They would, as soon as they saw that inflation burst forth in 2021, they would have gotten right on top of it. But the Federal Reserve waited, and having waited too long, they then had to raise interest rates much higher than they otherwise would have to get on top of the issue. So I would say this, that the Federal Reserve is still behind the curve, that they actually should have cut in July or maybe even earlier than the July meeting. They just decided not to cut in July, and then they went with a 0.5 percentage point decrease in September, I think recognizing they're behind the curve. That the problem now in America, the risk facing America right now has less to do with inflation, because pricing power in corporate America has really died down to a large extent among retailers, grocery chains, so on and so forth. The primary issue now is the disorderliness emerging in the labor market, this rising unemployment. And they probably should have been working harder and more aggressively before this period, before September's meeting, to try to revive some of the labor market stability. Because when it starts to fall apart, it falls apart very, very quickly. It can. So one of the reasons I think there's going to be a recession is because I've never had that much faith in this Federal Reserve. And part of that's because they blew it in 2021. I'm Monday morning quarterbacking here. I get it, because we were still in the midst of a pandemic and we didn't know what we didn't know, so it's kind of unfair what I'm saying. I understand that. Nonetheless, they missed it. And I'm telling you, previous Federal Reserve Chair people, certainly Alan Greenspan. I don't know if you remember Alan Greenspan, what he did in 94 and 95. He jacked up rates, even though there was no evidence of meaningful inflation, because he was worried that there could be. He's an inflation fighter, an inflation hawk of the highest magnitude. So what can I tell you? I think that they're still behind the curve, and that's one of the reasons I believe there's... Now, here's the good news. If I'm right that there's more economic weakness in front of us, they're going to lower interest rates that much more quickly in 2025 and 2026, and that'll set the foundation for the next burst of economic growth in America to come thereafter. That would be my prediction. The question here, maybe we have time for one more? I don't know. Oh, well, she was sitting, so that tells me that she thought we were done. Let's just do one more then, yeah.
Where is it?
It's there, okay. Toward the middle of the room.
Just real quick, I wanted to get your opinion on what Jamie Dimon said for JPM Morgan about not worried about the recession, but stagflation. I was wondering if you could flesh that out a little bit.
All right, so Jamie Dimon, of course, the most powerful person on Wall Street, CEO of JP Morgan, a gentleman who has created massive amounts of wealth for JP Morgan shareholders for decades. So he has earned that respect. And he has indicated that he's nervous about stagflation. So what is stagflation? That's the combination of stagnation, meaning very slow economic growth below trend growth, and inflation, meaning above 2%. It's something you would associate maybe with the Jimmy Carter period, for instance. Not to blame him for that, but it coexisted with his presidency. Yeah, it's possible, right? Because you've got these supply chain issues, you've got still labor market strife out there. All these things are inflationary. Right, the drive up, push up costs and therefore prices. And I'm suggesting to you that these lag effects from our interest rates could still generate further episodes of economic weakness. So you put that together, weaker than trend growth, higher than trend inflation, that's at least stagflation light, and that's what Jamie Dimon's talking about, and I think he's probably right on that. But we will see. The inflation numbers, I have to admit to you, have not been particularly troublesome lately. In fact, inflation has often come in below expectations. So if that continues, I'm dead wrong, and so is Jamie Dimon. But I think you're going to see some stubbornly high inflation readings going forward for reasons we've talked about. So that's what Jamie Dimon's getting at, and I think he's got a point. Thanks a lot for the opportunity. It's been a privilege.